Good evening. This is Ken Long from Tortoise Capital Management with a weekly market commentary on December 5th, 2010. I want to start off with the weekend report for Friday's daily. We still have a market that's in bull normal. It's in the mid-range of the annual channel. It's overbought on a 10-day basis. The leading candidates have been all in the materials and basic industries, so DuPont, Alcoa, GE, Caterpillar, and Bank of America. The 10-day max pain candidates in the Dow: Cisco, Hewlett-Packard, Procter & Gamble, Travelers, Johnson & Johnson. The winners have been the commodity areas, like the miners, South Africa, oil and blended commodities, South Korea. The losers in the ETFs have been long-term treasuries and China. On the gap stat for the S&P 500, there has been a reversal of the gaps that happening 60% of the time in the last 3 days. You can see this gap down and reversed and gapped up and reversed a total of 60% of the time, and then only about 40% of the time has it continued to move in the same direction as the gap. So the reversal is something we definitely want to be playing for, which means that it's to our advantage to wait 10 or 15 minutes in the morning to try to capture the reversal for the day. No signals in the overreaction or channeling and pivots that you can see. Volatility is pulled back to the mid-range of normal, and is stable, seems to be stabilizing. The trendiness in the market dipped under 15 on ADX and is now starting to creep above. And with green in charge, that's a very favorable sign, according to our good friend Chuck LeBeau. Looking at the mosaic indicators, we're neutral on the weekly RSI. We are still bullish based on the 200-day moving average with respect to price, and the slope of the 50-day moving average, both being in the green, is very favorable compared to where the readings have been in the last 6 months. ADX, you can see, is just nudged back above 15, and that's very favorable for identifying the early stages of the next possible trend. The 10-day index at 97, which is similar to Williams percent R, once as I've talked about before. Short-term overbought, and volatility is at normal. Now, the only signal that we had, 551W, turned out to be Hewlett-Packard, and that's because of the 3 days of persistent gains. That tends to reduce the number of signals we get, which are by and large based off of pullbacks in measured trends. Looking at the daily tactical, we can see in red the percent losers on Friday: Cisco, Travelers, Kraft, Home Depot, and ExxonMobil. The winners being DuPont, Alcoa, Caterpillar, and Bank of America. The predominance of green on the 10-day index says that those are all the ones that are overbought on a 10-day basis, with only Cisco lagging the market. It's at 1 on its 52-week index as well, so it has been really punished of late. Over in ETF land, you can see the predominant number of things that have been overbought, and again on Friday you can see all the winners were in the materials and precious metals. So you're getting oil, blended commodities, agriculture, silver, and gold. Only treasuries suffering, and natural gas suffering the most on the 3-day and 10-day max pain. Looking at the Dow summary, excuse me. Again, you can see Cisco standing out. To me, that becomes an anomaly that could be corrected next week. We will see that U.S. technology hasn't been bad compared to the other indexes. But in the high-tech space, we might be better off looking at Hewlett-Packard, since that one, or Microsoft, because they have not suffered as much. However, a correction in Cisco would not be surprising. You can see the strength again in Caterpillar, Alcoa, have been, and Home Depot have been very prominent, along with the basic materials. Half a dozen dojis, but as you can see, no pullback signals have fired. The max pain range compression leaders, not surprisingly, Cisco, Procter & Gamble, Travelers, Johnson & Johnson, and Pfizer. In the ETFs, we not only have no dojis and no signals on any of the pullbacks. We can see treasuries are getting smashed. Silver has resumed its powerful place at the top of the ETF stack. Europe, long-term treasuries, the Euro-Asia blend, S&P consumer staples. That's a bit of a surprise to me. That one may be a reasonable defensive play to examine, and then natural gas from the max pain range compression. I still think the Europe and Asia and emerging markets pullback, we will see in a minute, has the farthest to go to capture its previous highs. So if you're playing for a rebound, just to test previous swing highs, those are going to be natural candidates. You can see the 30-day regression line in SPY. We're back up above the slope line. Not surprising since we're overbought. And you can see the percent stretch above the 200-day moving average has come back up to +1 standard deviation over the 180-day average. And you can see we're forming a double top here in SPY. If it can clear this number about 123, that would be interpreted as a very favorable sign for the U.S. compared to the rest of the world. What I'd like to do in the minutes remaining now is take a quick look at the market health check. Let's see if we can get this sorted out here. All right, so we're taking a look at the S&P's market health check here, SPY, and we're looking at 10, 20, and 30 days back, so this is a 2-month look back. And the 30-day regression line slope is up, and there's the channel caused by the 30-day regression line. And we're back above the midpoint, and we're testing near the top of this channel, and we're retesting the previous swing high at 123. And you can see ADX starting to hook back up, and green over red, meaning that the beginning trend is a bullish nature. You can see here in the blue shaded area, the 200-day moving average boundary, and all the red lines have been previous support levels that have held. We dipped into oversold conditions 2 times in the last 15 days and are now back up into overbought. And if we can get through this 123 level, there's a lot of room to go ahead.